Good morning, options traders. Well, we had a really good question from one of the traders in the group yesterday asking about the stock repair strategy. And this is one that has been popularized by the Chicago Board Options Exchange. It's actually quite a common strategy, but it's one that they talk about a lot. And in fact, he did send a link over from the webpage showing kind of some of the basics of the strategy and was just asking for some more insights. So with today's environment, coronavirus, lots of people holding shares of stock that are down, and they're saying, is there a way to get my money back faster? And so that's the idea behind the stock repair strategy. So let's take a closer look and see what makes it tick. So once again, the idea is that you've purchased shares of stock and the price drops, actually quite significantly. What do most traders do? Well, they might do what's called a hold and hope strategy. And they say, well, I hope the shares will come back, and many times they will. But it might take a long time to recoup your money. You could also do what's called doubling down. You own 100 shares, stock price drops, you buy another 100 shares. And yes, that will reduce your break-even point, but it also increases your downside risk. Because you used to have, let's say, 100 shares, now you've got 200 shares. And as we'll see, the stock repair strategy will not expose you to this additional downside risk. So what can you do? The price is down quite a bit and you're going, I can hold and hope or I can double down. Well, if you understand options, there is a third choice, and that is the stock repair strategy. It's important to understand that before you use the stock repair strategy, you must be at least somewhat bullish on the underlying. You do not want to use this strategy if you say, oh, I think it's absolutely going to continue coming unraveled, because again, you're going to have this unlimited downside. So what you're saying is that you'd like to get your money back, but you're just trying to accelerate the pace at which you do that. So again, you've got to at least have somewhat of a bullish outlook. Well, who else should consider using it? Well, it works best where stocks are down about 15 to 20%. Obviously, if they're down a lot, no strategy is really going to repair you. Buy the shares at 100, they're trading for 20 bucks. Don't worry about the stock repair strategy. It's not going to help. Stocks are down 5%, why worry? That happens all the time. But if you're in this kind of this dilemma zone where they're down a pretty good chunk, not unheard of, but enough to where it might be a while to get your money back, it's a good strategy to use. Now, another important point is that your goal is to break even. Or you might say, okay, I'm even fine with maybe a small loss or to a slight gain. But you're not putting the strategy on to really make money. Instead, you're saying, I'd like to get my money back and just walk away from the trade. I wish I'd never put my money in here. Just give me my money back and I'm out. So that's kind of the philosophy behind the stock repair strategy. So what is it? Well, it's actually making use of what's called a ratio spread. So a ratio spread is where you are, let's say, going to buy one call, but you are going to sell two or more at a higher strike. And that's why it's called a ratio, because they're in unequal proportions. So let's say that you buy one $100 call, but you sell two 105 calls. So in the business, we might call this a 1/-2 spread. You're long one, short two. This spread by itself, if you just entered this ratio spread, would have a profit and loss diagram that would look like this. So it's a neutral strategy, but you can see there's a big risk of this unlimited upside risk. We do have, at least the way that I've drawn this diagram, a potential for a small loss if the stock price drops, but depending on prices and depending on the ratios you use, you might be able to kind of lift this lower leg up to where we actually have a slight gain. But regardless of whether we have gains or losses on the lower side, the idea is we're looking for the strategy to kind of stay towards this short strike. That's where the maximum gain is going to be made. Okay, so it's a neutral strategy by itself. Well, you might say, well, I don't like this unlimited upside risk. And that's true, but remember, you're not using this strategy by itself. Instead, you're going to combine it with your long shares of stock. Remember, your long shares of stock that have fallen in value. So why doesn't it create unlimited upside? Well, here's your 100 shares. And if you buy the $100 call and sell two 105 calls, here's your ratio spread in red. Well, let's take a different look at this ratio spread. Let's break up these two calls as two separate trades of a single 105 call. Now pair one of those 105 calls with your stock. And what do you see now? Over here on the left is a covered call, and on the right is a vertical spread, neither of which has unlimited upside risk. In fact, both of them level off. So we should see in our profit and loss diagram a flattened portion on that profit and loss curve above the 105 strike. So if we actually put this on, this ratio spread with our 100 shares, this is what we get. As I've always talked about in these profit and loss diagrams, we get a bend at our strikes. Here's our long 100 call, and here's our short 105. So notice we still have the unlimited downside risk, but the strategy didn't introduce that. This is risk you had from the 100 shares that were in the account before the strategy was ever put on. So this hasn't changed. The reason we're doing this is to create this angled portion right here. See, now I've got 200 deltas to help recoup my losses. Down here, it's not quite as steep. These are my 100 shares. But if the stock hits 100, what happens? I've got 100 shares, there's 100 deltas, plus I have the 100 call. There's 200 deltas to ride through here. And then of course, if we hit 105 or higher, as we saw before, we're just going to flatten out. So the idea of the strategy is that we're trying to increase the deltas through here, or through some range, so that we can recoup our money faster. So here's an example. Let's say that we purchased 100 shares of stock at 100. This is our profit and loss diagram. But now the stock has taken a 15% hit. It's trading down at 85. How can we use the stock repair? Well, maybe we buy the 85 call and we sell two 95 calls. Now, why did I choose these two strikes? Well, the first one is I want to get that long position pretty close to where the current stock price is, so that I can start generating those 200 deltas sooner. But the real reason that I'm going to choose my strikes is I'm trying to get a net zero on the trade. In other words, if I spend $5 for the 85 call, I'm going to try to find a strike that's trading for $2.50. And if I can sell that twice, I'm going to spend 5, collect 5. It's not going to cost me anything. So this is the second big benefit of the stock repair. You're selecting your strike so that there's no net cost. Now in reality, yeah, there might be a tiny debit, there might even be a small credit. But you're just trying to put this on for free, and that's why you're giving up the upside potential gains. Now you also might need to use longer dated options than you're maybe used to using. Might need to go out 30 or 60 days depending on the volatility and the price of the stock. But all things being equal, you should prefer to buy lower strikes and sell higher strikes. So you're just going to look through your quote board, and we'll look at an example in a moment where you can do this. Try to find the lowest strike you can buy for a certain price, sell two higher strikes as high as you can, but to recoup the cost of that long. So in this previous example, if we bought the 85-95 ratio spread, we have shifted from the blue curve here to red. So you can see the benefit now. By increasing those deltas, I break even down here instead of here. See, my old break even was at 100, that's why I bought the stock. Where is this? Well, think about it. If the stock is 85 and it has to go to 100 to break even, that's 15 points. But because I have 200 deltas now, I'm going to reach that point halfway. So half of 15 is 7.5, added to 85 is 92.5. So now I'm going to break even at 92.5 instead of 100. So I've lowered it by 7.5%. So let's swing over to the E-Trade platform and take a look at how you can select your strikes. So here we are in the E-Trade platform, and I'm going to use Apple for the demonstration. Stock closed at 388 and change. Markets aren't open yet, so let's just use this as our price. Let's say that hypothetically you bought this stock previously maybe at 400 or 410, so it's down quite a bit. Now at this time, the highest trade for the year has been just about 400, but again, hypothetically, let's say it was even above that. And these are the prices that we're now looking at. How would you choose your strikes? Well, the first thing I want to recognize is with the stock at 388, I would like my long option to be somewhere near here. I don't want the 400 strike. I want to start generating those deltas now. So I might look for the 380 or the 385, maybe even the 390. But it's going to be somewhere in there at least for starters. So we're going to come down. I'm just going to choose this expiration with 16 days. If I can't find strikes that work, I might try a longer dated set. So for starters, let's just say here's the 380 strike. It's 8 points in the money. And I look over here at the mark, and that's 1990. So let's just call it 20 bucks. Once I have this price, all I need to do is find one that's trading for about half this price, because I'm going to sell that one twice to pay for this one. So we look down the list, and right here, almost a perfect match, just a touch over 10. This actually might be a slight credit for this trade, but it's pretty close to a net zero. And if we look to the right, that's the 400 strike. So think about it, between 380, your long position, and 400, the short position, that's 20 points where you are controlling 200 deltas. And it didn't cost you any money out of pocket to put that on. So that's really the basic idea of how to find your strikes. Now, in the real world, you might want to try other pairs, find where your break evens would be, maybe check out some longer dated expirations, and try to find one that is the best for you. But hopefully, again, that at least gives you the basic idea of how to get started. On a more important note, I think what's interesting about the stock repair strategy is that just because you might hear of a strategy that is risky by itself, in this case, the ratio spread, doesn't mean it's one that you shouldn't understand and explore. Because when you combine it with another strategy or another position, it might solve a very important problem. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course and strategy lab at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.